In September 1998, two Nobel Prize winners sat in an office in Greenwich, Connecticut, watching their life's work collapse in real time. Their fund had already lost more than $4 billion. The Federal Reserve was making emergency phone calls. Warren Buffett himself had offered to buy the whole operation, and they turned him down. The most admired hedge fund in history was days away from pulling the global financial system down with it, and the managers still believed the math was right. It wasn't. John Meriwether wasn't the type to show up on magazine covers. He was quiet, methodical, and completely obsessed with numbers. In the 1980s, he built one of the most profitable trading desks in Wall Street history at Salomon Brothers. Not by taking wild bets, but by finding microscopic pricing errors nobody else was looking for. His strategy was called Convergence arbitrage. Here's the plain version. Two government bonds, almost identical in structure, sometimes trade at slightly different prices, a fraction of a percent apart. Meriwether's team would buy the cheaper one and sell the expensive one, betting the prices would eventually close that gap. Simple, boring, massively profitable when done at scale. The scale came from leverage. Because those price gaps were razor thin, you needed to control enormous amounts of capital to make real money. So for every real dollar the fund held, the team borrowed many more. Those thin spreads became thick profits, as long as everything went according to plan. Meriwether left Salomon Brothers in 1991, forced out after a trader on his watch was caught manipulating U.S. Treasury auctions. It should have ended his career. Instead, in 1994, he raised $1.25 billion and launched long-term capital management from a quiet office in Greenwich, Connecticut. And this time, he didn't just hire traders, he hired the architects of modern financial theory. Robert Merton and Myron Scholes, the two mathematicians who had created the formula the entire global options market is built on, joined as partners. In 1997, while the fund was running at full speed, they won the Nobel Prize in economics. The fund also included David Mullins, the former vice chairman of the Federal Reserve. The returns were unlike anything the market had seen. 21% in year one, 43% in year two, 41% in year three, all after fees. Then, at the absolute peak of their success, they handed $2.75 billion back to their investors. Not because something was wrong, because their models said they had more capital than they needed. They wanted the machine to run leaner, like they were managing a perfect mathematical operation, not a bet on the future. That decision tells you everything about what came next. Long-term capital management wasn't running a normal fund. They believed they had engineered a way to scientifically eliminate risk. Their models analyzed decades of market history to calculate the odds of every bad scenario. What are the chances that bond spreads in Europe and America blow out simultaneously? What's the likelihood that Russian debt and mortgage securities crash in the same month? According to their calculations, these events were so statistically unlikely they might happen once in thousands of years. In fact, after losing $550 million on a single day in August 1998, researchers discovered the fund's own models had calculated that event should happen once every 800 trillion years, roughly 40,000 times the age of the universe. So they built leverage to match that confidence. By early 1998, the fund held $5 billion in real equity, but controlled $125 billion in assets. For every dollar they owned, they were responsible for 25 more. On top of that, derivative contracts with exposure exceeding $1 trillion. Think of it this way. You own a $100,000 house, but you borrowed $2.4 million to buy 24 more, convinced the prices can only go up. If they rise 2%, you're a genius. If they fall 4%, you owe more than you can ever pay back. That was long-term capital management. Except the houses were sovereign bonds and complex derivatives, and the lenders were the biggest banks in the world. What made it even more fragile, Goldman Sachs, Merrill Lynch, Deutsche Bank, and dozens of others had been quietly copying the fund's strategy. By 1998, half of Wall Street was crowded into the identical positions. The fund's models assumed each trade was independent of the others. They weren't. They were all standing on the same side of the same cliff. The first warnings came quietly. In May 1998, the fund lost 6.4%. In June, another 10%, back-to-back losses unlike anything in the fund's history. The partners reviewed the models. The models said stay the course. They stayed. On August 17, 1998, Russia announced it was defaulting on its domestic government debt and devaluing the ruble. For global investors, the signal was immediate and primal. Nothing is safe. Within hours, capital flooded out of every risky asset on Earth and into U.S. Treasury bonds, the one thing the whole world still trusted. In that single movement, every position long-term capital management held moved against them at once. The spreads that were supposed to converge exploded outward instead. And because every other major institution held the same positions, there was nobody on the other side of the trade. Everyone was selling, nobody was buying. On one trading day alone in August, the fund lost $553 million. By month's end, they had lost 44% of their remaining capital. $4 billion. 4 months. Every equation they had built, failing in real time. By September, the fund's equity had fallen below $600 million, but it still owed $125 billion to its creditors. The same leverage that had made the fund legendary was now a loaded weapon pointed at the global banking system. If long-term capital management failed, every bank that had lent it money would be forced to liquidate those positions simultaneously. That kind of fire sale could freeze credit markets worldwide. Alan Greenspan, the chairman of the Federal Reserve, told Congress that the potential damage could have impaired the economies of many nations. On the morning of September 23, 1998, Warren Buffett, alongside Goldman Sachs and Berkshire Hathaway, made a last-minute offer, $250 million, to buy out the partners entirely, with a $3.75 billion capital injection to follow. Meriwether had a window of less than 1 hour to accept. He declined. That same afternoon, the Federal Reserve Bank of New York organized an emergency agreement. 14 of the world's largest banks together put up $3.625 billion in exchange for 90% of the fund's equity. The Nobel laureates, the former central banker, and the man who had built the most celebrated hedge fund in history walked away with 10 cents on every dollar. No arrests, no criminal charges. The fund was quietly wound down. The losses were absorbed by the institutions that had celebrated it the loudest. So what does the most credentialed fund in history actually teach us? First, leverage is not a strategy. It's a multiplier in both directions. Long-term capital management's returns were not magical. They were ordinary returns amplified by borrowed capital at 25 to 1. The same force that doubled and tripled their gains destroyed them at equal speed when markets moved the wrong way. Before you invest in anything promising extraordinary returns, ask one question: how much of this is borrowed money? Second, in a crisis, everything crashes together. The fund held dozens of positions it believed were independent of each other. When Russia defaulted, they collapsed simultaneously. In genuine panic, investors don't analyze, they liquidate everything and run. Real diversification means owning assets that survive differently under actual stress, not just things that look different on a spreadsheet in calm times. Third, a model is not reality. It is a simplified map of reality, built entirely from the past. Long-term capital management's models had never seen a scenario like August 1998. The market has never once cared about your equations. And the hardest lesson: credentials are not protection. 2 Nobel Prize winners and a former central bank vice chairman still lost billions. If anything, the prestige made it harder for anyone to ask the basic questions. The smarter someone sounds, the more carefully you need to understand exactly how they make their money, because the gap between the model and reality is where everything goes wrong. The next financial genius is already building their model right now. Perfect track record, flawless logic, and a blind spot they haven't found yet. Every collapse starts the same way, a model that's never been tested until the day it is. Subscribe to Capital Sins so you don't miss the next fall from grace before it happens. Up next, how Lehman Brothers turned bad mortgages into a global catastrophe that almost ended modern banking as we know it. Click the video on screen. And if you spotted these red flags before the crash, drop a like. You earned it.